Hello friends, a billionaire tried to crush Bitcoin, and it didn't work. Yesterday prices dipped, sentiment panicked, and then almost like a switch flipped, Bitcoin surged. If you blinked, you missed the moment the crash turned into a squeeze. This wasn't random, this was a stress test for the entire crypto ecosystem. And here's the part most people overlook. The failed bet revealed cracks in strategy, psychology, and market structure, while highlighting Bitcoin's resilience. One detail, which most headlines won't mention, could shape the next phase of the crypto market. Today we'll break down exactly why the billionaire strategy failed, what the market is signaling, and what could come next for Bitcoin traders and investors. The numbers, the psychology, the mechanics, all of it matters. Let's dive in. One billionaire allegedly placed a massive short against Bitcoin. Analysts claimed it could trigger a market-wide crash. Prices dipped sharply in hours, and social media exploded with panic. Headlines screamed, "Bitcoin is falling," but the market didn't collapse. In fact, Bitcoin rebounded quickly, almost erasing the entire drop. This shows a critical point: one player, even a billionaire, cannot control Bitcoin's price in today's market. The bet reportedly involved billions in short positions across multiple exchanges. It was large enough to create concern even among seasoned investors, yet the market absorbed it. Exchanges provided liquidity, retail demand acted as a shock absorber, and derivative positions created a buffer. Panic selling turned into a buying opportunity. The billionaire's strategy, which might have worked in the past, simply failed this time. Why? Bitcoin is more resilient today. Global adoption, diversified wallets, deep liquidity, and institutional presence make it harder for one person to manipulate. Sentiment alone can't drive markets. Structural strength matters more. Even when fear spreads, the ecosystem corrects. Here's your first cliffhanger. If one oversized short couldn't break Bitcoin, what happens when multiple institutional flows collide? Could the next wave create volatility or a breakout? Analysts are watching closely. And the next phase may surprise everyone. The attempted crash was fast and brutal. Prices fell over 8% in just a few hours. Panic swept through retail investors, and social media lit up with "Bitcoin is tanking." But the market's reaction was faster than anyone expected. By the end of the day, Bitcoin regained nearly all of its losses. This wasn't luck, it was structure. The dip revealed a hidden truth. Buyers were waiting panic, selling fueled the rebound, leverage amplified the effect. Shorts were forced to cover, liquidity moved between exchanges, and the price flipped direction sharply. In seconds, the market went from fear to demand-driven pressure. Analysts call this a trapdoor reversal, where aggressive moves intended to push price down end up amplifying the opposite reaction. Compare this to past crashes. In 2017, a similar dip took weeks to recover. In 2021, rebounds were slower and less predictable. Today, Bitcoin snaps back in hours because exchanges, derivatives, and holders act as shock absorbers. The system is smarter. The market reacts mechanically, not emotionally. Cliffhanger. This wasn't just a bounce. It may be the start of a larger trend. The billionaire bet didn't just fail. It exposed weaknesses in manipulation strategies, while highlighting market depth. Are we entering a period where large shocks trigger bigger recoveries than before? The next weeks may hold the answer. Why did Bitcoin hold during the attack? 3 reasons: supply limits, investor structure, and market depth. Bitcoin's supply is capped at 21 million coins. You cannot print more. Millions of wallets hold coins, creating a distributed network of buyers and sellers. This prevents one player from dominating. Exchanges provide another layer of resilience. Futures, options, and ETFs create liquidity. When the market moves sharply, these instruments act like shock absorbers. They balance supply and demand mechanically, not emotionally. Market reactions are faster than social media panic spreads. Retail behavior also plays a role. Experienced holders buy the dip instead of chasing peaks. They absorb pressure while inexperienced traders panic. The billionaire bet was absorbed by a combination of patient holders and exchange mechanics, creating a powerful counterbalance. Cliffhanger. If Bitcoin's foundation is this strong, what happens when multiple large bets collide? Could a concentrated attack trigger an even more explosive move? Analysts are quietly monitoring funding rates, open interest, and whale wallets to anticipate the next momentum shift. Psychology drives markets as much as numbers. When a large short fails, panic turns into opportunity. Casual investors panic sold. Experienced holders waited. Forced short covering created momentum. The market flipped in hours, proving that fear alone cannot dictate Bitcoin's price. The billionaire SEP's failure changes perception. It signals that Bitcoin is resilient. One player cannot crush the market anymore. Retail investors gain confidence. Even media narratives adjust. Bitcoin survived, becomes the story, not Bitcoin crashed. The market now rewards patience and punishes emotion. This failed attempt illustrates the principle clearly. Emotional traders get squeezed, strategic traders profit. When a large position is exposed, the system forces it to react. Cliffhanger: perception drives momentum. If news spreads that Bitcoin is uncrushable by one person, headline-driven rallies and short squeezes could dominate the next phase. Who will react first? Exchanges played a subtle but critical role. Margin requirements were adjusted mid-session. Leverage forced shorts to cover. Overnight gaps hit key technical levels. Liquidity moved seamlessly between wallets, exchanges, and derivatives. The billionaire's position may have been partially frozen. That trapped the short, limiting maneuverability. Trapped positions amplify rebounds. Mechanically, the market punished oversized exposure. What was intended to push price down became the lever that pushed price up. Leverage amplifies both risk and opportunity. Exchanges signal stress, and traders follow those signals. Bitcoin's bounce wasn't random. It was mechanically reinforced. The system punishes outsized positions. Cliffhanger: what happens if multiple players take leveraged bets simultaneously? Bitcoin is primed for a short squeeze scenario that could exceed prior movements. The pressure is building silently, but the next trigger could be explosive. Bitcoin didn't exist in isolation during the billionaire's attempt. Macro factors reinforced its resilience. The US dollar paused its rebound, reducing pressure on dollar-denominated assets like Bitcoin. Risk appetite returned in tech stocks, crypto funds, and global markets. Even equities provided indirect support. Institutional involvement matters more than ever. Hedge funds, ETFs, and over-the-counter trades add depth. When one large short failed, these players absorbed volatility, stabilizing the system. The market no longer relies purely on retail sentiment. Every spike and dip is moderated by multi-layered liquidity. Supply and adoption remain crucial. Millions of wallets globally act as shock absorbers. New entrants, staking platforms, and corporate holdings create distributed demand. The failed bet was significant, but the ecosystem is far larger, deeper, and more resilient than one headline suggests. Cliffhanger: if adoption continues to grow and macro trends favor risk assets, what happens when another oversized bet hits? Will Bitcoin shrug it off again, or could this be the start of a multi-phase rally? Analysts are watching subtle signals, from funding rates to whale activity, to see how momentum will build in the coming weeks. Bitcoin's failed crash mirrors past events, but with a twist. In 2017, a similar panic sent prices plunging over 20% in days, recovering slowly over weeks. In 2021, short-term squeezes created volatility, but markets lacked the depth to snap back immediately. Now the recovery happened in hours. Patterns emerge in these scenarios: concentrated exposure, liquidity stress, and rapid rebounds. When one big player bets aggressively, the market punishes weak hands and rewards patient participants. Momentum moves like waves, ignoring headlines, following mechanics. The billionaire's bet failed because the market has evolved. This is important. History doesn't repeat exactly. It rhymes. Large concentrated bets no longer guarantee profits. Volatility is amplified, but rebounds are also faster. Bitcoin now behaves like a mature asset, resilient to single-player manipulation. Cliffhanger: if history rhymes, the next big move could catch everyone off guard. Could this be the start of a short squeeze era for Bitcoin? Concentrated shorts, frozen positions, and retail momentum may create explosive volatility in the weeks ahead. During chaotic periods, the real story hides in the data. Funding rates, open interest on futures, exchange liquidity, and whale wallet movements reveal underlying strength. Paper markets are volatile, but real demand shows where money actually flows. Short-term dips are absorbed quickly. Borrowing costs indicate urgency. Price behavior highlights stress zones. The failed billionaire bet is only a signal. True insight comes from following these indicators. Savvy traders watch quietly while the headlines scream. Fast rebounds and elevated funding rates often precede short squeezes. Exchanges adjust margin requirements. Leverage forces cover positions, and liquidity creates momentum. These mechanics tell a more accurate story than headlines alone. Cliffhanger: if these signals align, Bitcoin could enter a phase of aggressive upward repricing. Who will react first? The retail crowd, institutional players, or the whales controlling deep liquidity? The first to act could profit massively, while the rest chase headlines. Bitcoin is primed for the next phase. Oversized shorts are exposed, volatility remains elevated, and momentum favors the prepared. The failed crash is now part of a larger sequence, Shock, panic, forced cover, rebound. Stage 1 is over. Stage 2 is coming. The next wave may be driven by retail, institutions, or a mix of both. News, macro trends and regulatory chatter will amplify moves. The failed attempt didn't end the story, it set the stage. Markets thrive on imbalance, and now one oversized short has been neutralized, leaving opportunity for reactive momentum. Psychology, leverage and adoption all intersect here. Markets respect mechanics, not narrative. The failed billionaire bet is a warning momentum is alive, and Bitcoin may be poised for a rapid upward shift if these factors converge. Cliffhanger, watch the next few weeks closely. Price levels above recent highs could trigger forced reactions no one expects. Are you prepared for the coming volatility? This could be the beginning of a multi-week repricing scenario. For holders, patience is key. Don't panic sell. The system absorbs shocks. Upside potential remains strong. Position sizing and risk management matter more than guessing the top or bottom. For traders, watch liquidity, leverage, funding rates, and whale activity. Volatility can create opportunity, but mechanical signals matter more than hype. Exchanges, margin adjustments, and funding rate spikes are your roadmap. React fast, but strategically. Bitcoin cannot be crushed by one player anymore. The ecosystem is resilient, distributed, and ready for the next phase. Oversized bets fail, but momentum and psychology create waves that savvy participants can ride. Cliffhanger, the failed bet is both a warning and a signal. Markets are alive, watching, and ready to punish or reward. Are you prepared to act when the next wave hits? Preparation, patience, and understanding mechanics are what separate survivors from spectators.